Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Job Curtis, manager of the City of London Trust. Hello, Job.
Hello.
So over 3, 5, 10, almost every multi-year metric you can look at, the trust is exceptionally well performing as compared to peers and the benchmark. But both the underlying benchmark and the trust has had a difficult couple of months since the start of the year. And I was wondering, what were those challenges and how did they shake out for the rest of 2018?
Well, I think it's two factors. There's the international factors, and in particular, you've got rising bond yields in the US and a rising interest rate environment. And so we've had a very calm period of low volatility, and suddenly people are waking up to the fact that shares can go down as well as up. So that's put some nervousness in the market. And I think the second factor is more domestic to the UK, and fears about Brexit out there, which so far the economy's performed well since the referendum, much better than some had feared. But there are kind of fears about Brexit, also political worries about the stability of the government, and those sort of things are weighing on some of the domestic sectors within the stock market.
I suppose it's also a reminder to not be short-termist. You know, it's something that we advocate here at Morningstar,
Absolutely.
As well as I know that you do in your investment process, that a couple of months does not maketh a longer term. But presumably
Absolutely.
some of these challenges are going to be around for the medium term, and there will be more volatility to come.
Yes, and I think we've had an unusually long period of low volatility, but I stick to the fundamentals, and in particular the dividend yields you get from shares, which still remain very attractive. I mean, the UK market's got a dividend yield of about 3.5%, which is way above interest rates. I mean, the Bank of England is signalling one or two more increases this year. We had the first increase for about 10 years last year, but we're still only at 0.5. If you've got two increases, you only go to 1%. So the dividend yield attractions from shares is positive. And also we've got a lot of growth out there. It's one of the reasons why the central banks feel safe in raising interest rates is there's so much growth. And that is feeding through to corporate profits growth and dividend growth. So it's not only a 3.5% dividend yield from market, but it's also a growing dividend yield.
How much does the point in the market cycle matter to returns as well? Because, you know, with the greatest will in the world, we cannot expect to have the returns over the next 3 years that we have over the last 3 years.
Yes, we've had a long period of bull run for stocks, really going back to 2009 with, you know, some blips, admittedly. And, you know, you have to be careful. That's why valuation is very important. But you are seeing profits growth come through from companies, so that is positive. But clearly equities, you know, are the more volatile asset class, the most volatile. And so, you know, if you put extra risk, you do in the long run get extra reward. But as you said at the beginning, you know, it's not something for the short term unless you're a speculator. You need to take a longer term view.
And you mentioned the negative implications of the Brexit uncertainty, but I know that some of your holdings have benefited from sterling weakness. Is that something that you expect to continue for a while?
Well, very interestingly, because we had a huge fall in sterling after the referendum, and from against the dollar it went from about 148 on the eve of the referendum, and it bottomed at about just in the low 120s. And actually, over the last 9 months, the pound has actually clawed back quite a lot of those losses. So as of today, it's about 138. You know, it has fallen against euro, but not by quite as much as the dollar. So, and the euro is benefiting from the stronger European economy. But so I think it's very difficult to predict currencies. But I think down in the 120s, the pound was looking very good value against the dollar in terms of some of the purchasing power type of calculations which people make. So, but I think the sterling is a barometer of partly of people's market expectations about Brexit, and so I think if we went to sort of hard Brexit or a cliff edge type of scenario, it could put some further weakness on the pound, which actually would be quite positive for equities. Because, as you said, many of them, UK equities at least, have big overseas interests, and you get a translation benefit immediately.
It sounds like there's so many factors that you can't predict. You may as well just stick to stock picking.
Well, yes, I think valuation is very important, and the great thing about, you know, if you're taking a long-term view, if you're investing in dividend-paying shares, then you are being paid while you wait. So you can sort of pick up your twice-a-year dividends or quarterly dividends, and, you know, that's getting a better income than you get in the bank, and, you know, that makes the volatility that might happen much easier to take, you know, as long as you have faith in the longer-term attraction of equities, which I certainly do.
Job, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.